Hi everyone, Maria Tyler here. In this video we're going to go through capital budgeting and look at some techniques which we can use to appraise whether an investment is likely to create its value or not. So what is it? It's essentially analysis of potential capital projects for long-term strategic decisions. It usually involves very large amounts of money, so large expenditures, and usually once you've committed you can't easily uncommit or reverse those decisions. We're talking about a firm's strategic or long-term. So make sure that every investment, firstly, before we even apply any of our capital budgeting techniques, should firstly be appraised in relation to our long-term or strategic vision. For example, if you're personally looking at buying a car, if you know that you're going to need a family car in a year, there's no point even looking at sports cars as a potential investment. So look at your long-term or strategic vision and then see whether this investment fits in with the strategic vision. If it does, then we can apply some of our techniques which we go through today. So this is very important. Firstly, all investments should be firstly appraised in terms of the overall strategic direction of the company. Okay, once we establish that it is within our strategic vision, then we have a look at some decision criteria, and usually all of the capital budgeting methods will address one or more of these. So do consider all of the cash flows. So not all of the techniques consider all of the cash flows. For example, payback period doesn't. Is it risk adjusted? Is there an ability to rank projects based on our different tools that we're using? And will it indicate the value that it adds to our organisation? They're considered the good decision criteria. We have what we call independent or mutually exclusive projects. So if projects are independent, that means we can basically choose all of them, whichever ones we want. Each independent project we could choose, as long as it's going to be a good investment, we could accept it. Mutually exclusive projects is not the case, it's the opposite. It means if we accept this project, then we can't accept the other. They're mutually exclusive. So the acceptance of one project precludes accepting the other. For our unit, we're just going to focus on 3 capital investment appraisal methods. So payback period, net present value, and internal rate of return. And they're the more commonly used appraisal methods in practice. The one that I most commonly use with my clients is net present value, and in conjunction with net present value, internal rate of return. Another one that is fairly commonly used is the accounting rate of return. So if you are interested in that, you can Google about it. But for this purposes of our unit, we're just going to focus on these 3 listed on the slide here. Okay, so with the first one, the payback period is probably the easiest to understand. It's how long is it going to take me to be paid back for the initial investment that I've made into this project. So we have to estimate cash flows for each period, and then basically so we have an initial investment amount and then take off all of those cash flows until the initial cost is recovered. So we're taking off every year the incremental cash flows that we get until finally we've been paid back for our initial investment. And so it's essentially a break-even type of measure. The decision rule is accept the project if the payback period is less than your preset or acceptable limit. So if we calculate a payback period of 2.5 years and our acceptable payback period is 3 years, then we would accept that project. If our acceptable payback period was only 2 years, then we wouldn't, because it's 2.5, which is longer than the acceptable payback or preset limit. So as an example, if you have nice even cash flows, you can simply put it into a nice mathematical equation, investment amount divided by the investment return. So how long until I get paid back for our investment of $5,000 if it returns a nice cash flow of $200 per year? 5,000 divided by 200 is 25 years. If that same $5,000 returned me $2,000 per year, it would only take me 2.5 years to be paid back. But in real life, you don't normally get a nice even cash flow amount like this. You normally get a different cash flow paid back every year. Well, capital projects for companies usually return a different cash flow every year. So we have to bring in cumulative cash flow. So here's another example, just calculated out with non-even cash flow. So we're assuming that our investment cost us $100,000 and we've got estimated cash flows over the next few years of or $15,000 for the next 3 years, so 15, 15, and 15, and then $30,000 a year for the last 2 years. What's our payback period? So this is our logic. Year 0, which is right now, times 0, our cash flow is negative $100,000. We're paying that. At the end of year 1, it's the negative 100 plus the 15,000 that we got back for year 1. So we're at negative 85. In year 2, we start with the negative 85 and we add the 15 that we get for year 2. So we're at negative 70. For year 3, we start with a negative 70. We add the 15 that we get in year 3. So we're at negative 55. In year 4, we start with a negative 55. We get 30,000 in the last 2 years. So 30,000, we're at negative 25. And in year 5, we start with a negative 25. We get 30,000. So we're actually at a positive 5,000. So we get paid back somewhere in year 5. So year 4 plus some months or days. So we get paid back somewhere in year 5. And we can actually calculate this by dividing the cash flow that we need to break even, i.e. the $25,000 that we need in order to break even, out of the total cash flow that we actually receive for that year, and then multiply it either by 365 days, 12 months, or leave it as is, as a decimal if you need it for a year. Now, a better way to calculate this would be to list out these as cumulative cash flow, and you can do this using Excel quite easily, and that's what we're going to be doing for your assessment. So you put year up the top in the first row. So year 0 is right now, and then year 1, 2, 3, 4, 5, 6. The cash flow that you receive or pay each year is then listed next as a second row. So in this case, negative 100,000. Then we get a positive 15 for the first 3 years, and we get 30,000 for the next 2, and we've tagged on 1 extra year there in my calculations just to show you the progression. Cumulative cash flow, negative 100,000. We add on the 15, so we're at negative 85. We add on the 15, we're at negative 70. We add on the 15 at negative 55. We add on the 30,000, we're at negative 25,000. And then in year 5, we add on 30,000. So we're at a positive 5,000 at the end of year 5. So somewhere between year 4 and year 5, we get paid back. Now to calculate that somewhere, we simply take what we need, whatever cash flow we need to break even, which is our 25,000 that we need in order to recoup our initial investment. We divide it by the total cash flow that we get for the next year. So the 25,000 divided by the 30,000. Ignore the negative sign. We're not interested in the negative. So 25,000 out of 30,000 that we need, and then times that by 365 days or 12 months, or leave it as a decimal for years. So if we times it by 365 days, we will get 304 days. So the payback period would be 4 years and 304 days. With the months, it's approximately 10 months. So payback period is 4 years and 10 months. And if we needed it to be expressed as years, then payback period would be 4.83 years. So do we accept or reject the project? Depends on what is the acceptable preset limit. So if our company decided that payback period within 5 years was acceptable, then we would accept this particular project. If our company had a accepted payback period of say 3 years, then in this case it wouldn't be acceptable. So we wouldn't accept this project. So advantages and disadvantages, obviously it's easy to understand. It is biased towards liquidity because it just deals with cash flow and recouping an initial investment. The disadvantages are it ignores the time value of money, i.e. $1 today is worth more than $1 tomorrow, because I can invest my $1 today and get more back with that $1 today tomorrow. So $1 today is worth more to me than it is $1 tomorrow. $1 today is also certain, $1 tomorrow is uncertain. So it ignores that time value of money. It requires some sort of cutoff point, that preset limit. So what is acceptable? It's arguable whether or not that's actually a good decision criterion. And also, this is probably the hugest one, it ignores all cash flows beyond that cutoff date. So pretty much once we get paid back, we ignore, and this is why I left this up here, we ignore the rest of the cash flows. So we might actually, so we've got cash flows in year 6, but for the purposes of calculating payback period, we just ignored it. We didn't think about it. So that's, yet it's important because not only did we get paid back, we got paid back more. So that's one of the disadvantages. So it ignores cash flows beyond that cutoff date. So that's payback period. Net present value tells us how much value is going to be created from proceeding with this investment. Now, there's two main points in net present value. There's present value and then there's net present value. And I'll go through that in the next slide. Firstly, step one is estimate all of our expected future cash flows. And in practice, that's the hardest thing to do. So in practice, actually getting or forecasting accurate cash flows over the life of the project, that is very hard to do. And when you study, you may study in business finance later on how we actually forecast those cash flows. You'll start to see some of the complexity that can be involved. In real life, I work with net present value with different businesses for different projects. And in real life, that's the hardest thing to get right, is estimating that future cash flow. Because A, nobody has a crystal ball, and B, what information we do have might change depending on a number of different scenarios. So this is actually, step one, estimate the expected future cash flows. That's easy in terms of our unit. You just make them up. But in reality, be aware that's probably the most critical step. Step two, estimate the required return for projects of this risk level. This is where your weighted average cost of capital comes in. This rate of return can greatly affect your net present value. It's basically an inverse relationship. So if you have a high rate of return, it'll give you a lower net present value and vice versa. And that's, again, it's another point of manipulation of net present value in practice in the real world. So I was teaching out west at some of the mines over 5 years ago now, and when we went through net present value with their capital appraisement methods, they said in their company they used to be able to, head office would have they would invite a number of capital submissions every year, and so managers of different mines would put in for their, what capital they would like for their particular mine using net present value, so that the decision makers wanted to see net present value of each of the capital investments. And so what was happening was some managers had figured out that if they use a lower discount rate or lower required return rate, we're going to look at it in terms of discount rate or weighted average cost of capital. So if they used a lower percentage rate, their net present value was higher. So they started to manipulate their capital investments. And so decision makers, if they didn't have an understanding of this, they would look at a net present value and think, wow, this is really high, this is really good. But the reason it was high is because they were using a lower discount for the present values of the cash flow. So what the company ended up doing, once they realised that this was occurring, they realised they weren't comparing all apples with apples, all the investments at different discount rates or different required return rates. And so they ended up specifying everybody had to use 7%, I think it was at the time. So they all had to use the discount rate of 7%, which was the company's considered weighted average cost of capital. So anyway, so that's an interesting story. So this is another area of manipulation, the actual discount rate or required rate of return. And this is the rate that we discount those future cash flows that we've predicted in step one. This is the step where we discount each of those back to today's dollar value. So $200 next year is not worth $200 today. It's probably only worth, depending on your discount rate, probably only worth say $150 today. Because we can get more. If we invested that $150, we could get the $200 at the end of the next year. So depending on your discount rate. So you can see, how do we discount it back? What interest rate do we use to bring all those future values back to a present value? This is where the present value comes in. Then step three is we find the present value of all of those cash flows. So we add them up, we get a total present value. And then to get the net present value, we subtract the initial investment amount off, and that's why it's called net present value. So just harping on that for a minute, what does the net mean in net present value? So just a very, very simple example I just quickly whacked up. Initial investment, say $5,000, returning us $200 per year for 5 years, using a discount rate of 7%. So $200 in 1 year at 7% discounted back to present value, to today's terms, is only $187. $200 received in 2 years is worth the equivalent of $175 in today's dollars. $200 in 3 years is worth $163 in today's value, discounted at 7%. $200 in 4 years' time, discounted at 7%, is $153, and so forth. So, or another way of looking at this is $187 today. If you gave me $187 today and I invested that at 7%, in 1 year I would have $200. If you gave me $175 today and I invested that at 7% for 2 years, I would have $200 at the end of year 2. So this is what discounting brings back, and investing brings it forward. So discount rate is 7%. So we're just converting one figure to the other for each time period using this percentage rate. So the higher discount rate or required return rate you have, the lower your net present value will be, and the lower the discount rate, the higher your net present value will be. It has an inverse relationship. So that's discounting the cash flows. So this is our cash flows. So we forecast that we have $200 per year returning to us for 5 years. We discount all of them at 7% to a present value. Then we add up all of these individual present values to get a total present value. The difference between this total present value of those cash flows and a net present value is we take off that initial investment of $5,000. So that's what the net means. So present value is discounted future cash flows, get a total, that's the present value of all of those cash flows. Take it away from our initial investment gives us net present value. So in this case it's negative, so we wouldn't proceed with that. So just on that decision rule, if net present value is positive, you accept it. If it's negative, you reject the project. Do not proceed. If it's less, if it's not positive, it's negative, it won't add you value to the firm and it won't increase your wealth. So only accept projects if they're positive. Net present value is a direct measure of how well this project will meet the goal of increasing our organisational wealth. So this is another example I just want to give you with discounting back and forth. So we're looking at a new project. We've estimated these cash flows for the next 3 years. Our initial investment is $165,000. Our required rate of return, or our discount rate, is 12%. Should we accept or reject? So in your assignment, you can easily, we're going to do it in Excel in our assignment, just to carry out this scary looking formula. But for those maths geniuses out there, I'd like to just go through this manually. It is very easy, and again, it's something you would have learnt in high school. Cast your mind back to high school if it's many years ago for you, like it is for me. So cash flow, each of the cash flows go on top, and we discount it by the number of years, T is time. Okay, so using our formula, cash flow for every year, so T is every year, R is rate, so 1 plus the rate, discounted for every year. So initially, year 0, we spent $165,000. In today's terms, it's year 0, it's right now, it's $165,000 spent, negative. At the end of year 1, we get $63,120 back. So put that into our formula. So cash flow goes on top here, divided by 1 plus the rate. So in our case, we've got the previous slide told us that our risk rate is 12%. So 1 plus the rate is 1.12 to the power of the year. So in this case, year is 1. So it's 63,120 divided by 1.12. So put that into your calculator and you will get a present value of $56,357.14. Year 2, we get a cash flow of $70,800. So again, put it into the formula, 1 plus the rate to the power, to the exponential power of 2 years, 2 for 2 years. So $70,800 is worth $56,441.33 in today's value. And at the end of year 3, we get 91,000, discount that by 3 years to that discount rate. So that is worth, in today's value, discounted at 12% to $64,828.94. So what we do to get a present value is we add the 56, and the 64. That gives us present value. Then we take it away from our 165 to get a net present value. So in this case, our net present value is positive. So $12,627.41. So we would accept this project. So that's the long way to do it. Excel does it all for you. You just put a formula in Excel and hit enter. So net present value method meets all of our decision criteria, all of our desirable criteria, considers all of the cash flows, it adjusts for risk and the time value of money. It can rank mutually exclusive projects directly related to increasing our wealth. So it's considered the main dominant method to use. So if all else fails, just use net present value. Internal rate of return, if you understand how the discount method, the discount percentage works with net present value, you'll understand internal rate of return. It's simply the rate of return when net present value is 0. It's the most important alternative to net present value in practice, and it's widely used because managers like to think in terms of rates of return. They like percentages, they can understand percentages. So actually a lot of managers prefer to use IRR, the internal rate of return, for them. So again, the higher the internal rate of return, the better the project is, and it must be above their set minimum, their preset level. Based entirely on the estimated cash flows. So it is the discount rate that makes net present value zero. The decision rule is accept the project if the internal rate of return is greater than the required rate of return. And usually that is for the mining company we were out working with in that particular instance, it was their weighted average cost of capital. So that's 7%. So it had to be greater than that discount rate that they were using. So so again, if it's less than that rate, then reject the project. So having a look at a quick example, we can't actually calculate it because there's no manual formula. Well, there is a manual formula. It's the net present value formula. But to manually calculate it, you have to use that formula and keep changing that discount rate to try and get net present value as close to zero as possible. So it's a trial and error method. Using the calculator, usually we'll be able to, there's a function that will say IRR. So usually able to either press that function first and then enter your cash flows and then compute, or enter your cash flows, press the IRR button and then compute. So something similar to that. But the easiest is to use Excel, and that's what we're going to go through today for your assessments. So do we accept or reject the project? Just assume we calculated an IRR using Excel or our calculators of 16.13%. That's greater than our required rate of return, which is 12%, so we would accept that project. So the advantages are it's preferred. Like I said, in practice, I found a lot of managers, they like to think in terms of percentages. They can understand, a rate of return. Like if I invest my money in the bank, I'm going to get, 4% interest, 5% interest. So they can identify with percentages. So they do like it. It's quite widely used. It's intuitively appealing because people, in essence, understand what a rate of return is. And it's easy to communicate the value of a project using a percentage. It does consider all cash flows and also discounts. It includes the discount value, so it considers the time value of money. But there are a few disadvantages, and mathematically, again, for the maths geniuses, when you graph IRR, it looks like a bell curve. So it can actually produce multiple answers because the point where it hits your axes, the curve actually can hit it twice. So it can produce multiple answers, which is confusing, and it can't rank mutually exclusive projects. We'll have a look on the next slide, just have a look at some of these figures which were actually used for two projects. So the required rate of return for both projects is 10%. With project A and B, these are the cash flows, so initial investment and cash outlays for 2 years. When we've actually calculated net present value and internal rate of return, because these were mutually exclusive projects, internal rate of return gave us conflicting results to net present value. So net present value came out high for project A and the internal rate of return came out high for project B. So then you're like, well, do I listen to the internal rate of return? Do I listen to the net present value? So the answer is, of course, net present value. Net present value is the dominant method to use. And internal rate of return actually can't rank mutually exclusive projects. So just be aware of that. When there is conflict between net present value and internal rate of return, always use net present value because it directly measures the increase in value to a firm. And also internal rate of return is unreliable with non-conventional cash flows and mutually exclusive projects, as we just saw. So just a quick summary before we go on to calculate or to show you your assessment. Payback period summary. It's the length of time until our initial investment is recouped. We accept it if it's less than our specified or preset limit, doesn't account for the time value of money, ignores all the cash flows after that payback period, and it's that arbitrary cutoff period. Net present value is the difference between our present value of our future cash flows and the initial investment. We accept it if it's positive, if net present value is positive. There's no serious flaws and it's our preferred decision criterion. Internal rate of return is the discount rate that makes net present value break even at 0. So we accept it if our internal rate of return, our percentage rate, is higher than our required rate of return. It's the same decision as net present value with conventional cash flows, but it's unreliable in these two instances. So just be aware of that. Don't use it if you've got those two instances. In practice, it's not just a matter of doing one criterion, although having worked with some companies in practice, that's all they do. They will just do net present value and that's it. Anyway, you shouldn't just do net present value. You should be able to do a number of these capital investment criteria. Use a number of tools that are available to you so you can actually get a broader picture of this investment. Net present value and internal rate of return are the most commonly used primary investment criteria, and like I said, I have worked with firms where they will only use net present value. Payback period is commonly used secondary investment criteria, as is the accounting rate of return. But all of the tools provide valuable information. So that's what I'm saying. If you've got tools available, you know how to use them, why not calculate all of them and just get that bigger picture view? Okay, so that's the background. So now with your assessment, you have to create a capital budgeting or capital investment scenario. So do that in your completed company spreadsheet. And I think yours will come with the template, net present value IRR. Yours will come with the template that I create from my example today. But essentially, I've created this example so you've got to think about your own company and you've got to create a capital investment decision for your company. So it has to have a minimum of 5 years of cash flow, no greater than 10 years of cash flow, and it has to be related to your particular firm. So it's got to be, unique to your firm. So get to know your firm. You should already know your firm. And it has to involve two different options, at least two different options. I would say no more, just limit it to two. So mine is here. I've listed it on this slide, and I've also typed it out for Martin to put on Moodle as well. So don't use this one. This is my example, which I'm going to read out to you now, but it's there, which you can use as an example. Martin's also given a similar one for Ryman Healthcare. Okay, so Wesfarmers is considering expansion into the small town of Claremont in central Queensland. Claremont's a bit close to my heart because my hubby's from Claremont. So in order to do this, they're considering two investments: opening a new Bunnings store and or opening a new Coles supermarket. Currently, Claremont has neither Coles nor Bunnings store. And I was just over there last week to visit the in-laws, and they still don't have a Coles or a Bunnings store. So ideally, Wesfarmers Limited would have no plans for closing these stores in the future, as it is anticipated that they would remain open for as long as they are profitable and solvent. However, since market demand for both Bunnings and Coles stores in Claremont is based on Claremont's population, which is very small, which in turn is highly dependent on the mining economy surrounding Claremont, it is suggested that each of these projects be given a length of 10 years. So this is all I'm just making this up. You have to look at your company and make up something that's reasonable. So there would be a demolition cost for the Coles store at the end of 10 years if it was to be closed down. And I put hint, this is a negative residual value, so negative cash flow at the end of year 10. However, the Bunnings warehouse could be sold to a local cattle farmer for hay storage. The cash flows generated by the Coles store would predominantly be comprised of consumer purchases of groceries, less operational costs such as staff wages and inventory purchases. The cash flows generated by the Bunnings store would be predominantly comprised of consumer purchases of hardware, less operational costs such as staff wages and raw materials. So I'm going to make the investment on the 1st of January, which actually is today's date. The estimated future cash flows are expected to be received on 31st of December of each year. The original cost, the estimated life, residual value, and estimated future cash flows of each investment are set out in the table below, and I've typed them into a nice neat table and copied it into the slides for you. I've said that all amounts are expressed in Australian dollars because all of Wesfarmers financials are expressed in Australian dollars, and we're actually using that weighted average cost of capital of 10% because that's what I used in my ratios as the cost of capital. So that's my discount rate or rate of return. So I've just made up these figures. Literally, I put the original cost in of 77 and 135. When I enter these into my Excel spreadsheet, I need to enter them with a negative inside because they are an outlay. This is the cost, so it's an outgoing cash flow. It's a negative cash flow. So when I enter them into my Excel spreadsheet, I need to put that negative there. The estimated useful life for each is 10 years. Residual value. So at the end, I'm going to be able to sell this one to the cattle farmer for his hay storage. So he'll pay me $2 million. But the coal's what I'm going to have to demolish, so it's going to cost me. So I'll put a negative 1.5 million. And the estimated future cash flows, so at the end of the year, at the end of 2 years, at the end of 3 years, and so forth, right up to the end of 10 years, are these. So I'm saying initially the Bunnings will probably have a negative cash outflow, but then it's going to be returning me some positive amounts. And I've literally just made them up. So in practice, this is the hardest thing to get right. But for this assessment, you can just make them up. It's nice and easy. But the coals have got -5, -1, and then all positives. Okay, so I've printed out this table so I can actually just refer to it when I'm typing into Excel instead of flicking back and forth. But this is where I'm getting my data from. We go to Excel to calculate those 3 different investment appraisal methods and then come back to your Word document to explain your decision. So this is part of what you would include in your Word document. So put your when you create your scenario, type it up, tell your marker what your scenario is, and then at the end, after you've calculated your net present value, internal rate of return and payback period in Excel, then come back and explain that back in your Word document as well. Okay, so opening up our Excel document. So what I'm going to start with, I'm just going to type in is my first option, which is Bunnings. My Bunnings store. Just one store. Okay. So start with my time period. 0 to 10. 0, 1, 2, 3. Now I can just highlight all of those and Excel will automatically know that I'm counting up in ones. Fill it across. Time period, I want to list my cash flow out. And this is where I need my little printed out sheet because what I'm doing is getting my cash flow from here. So I'm going to have to enter my -77 million, then my -4 for year 2, my -5 for year 3, and all the way up to year 10 where I put -11 plus, sorry, a +11 plus my +2 residual value, which I get at the end of my 10 years. So I'm just going to go and enter those in now. This is for the Bunnings store only. So -77, -4, 5, 15, 20, 20, 21, 21, 10. No, I've missed one. Hang on. Oh, there's 3 20s. There you go. 25, 25, 10. In the last year, I've got the 11 million plus my residual of 2 million. Okay, so that's my inputs so far. Merge and center that. I'll highlight that. Let's make it nice and blue. Okay, my time period I'm going to put in bold so I know that's my years. My cash flow, these are my dollars, so I can put them in dollars. Actually, you know what I should do? Take away the decimals. Insert here, Control Y to get a few more lines, and put all figures are expressed in millions of Australian dollars, so that my marker knows that I'm actually leaving these figures in millions. Now for net present value, all I have to do is go equals net present value. Oh, actually, also let's put discount rate and I'll put 10%. So you can either leave it as a decimal or you can change it to a percentage, it's up to you. So I'll put equals net present value, open bracket. See how it's got rate here? I'll click in this cell, then press a comma. Now it says value 1, value 2. So what I'm going to do is actually just highlight all of my cash flows up to year 10 and then close brackets. Now if I just enter that, that doesn't give me the net present value. That only gives me the present value. I actually have to take off, or in this case add on because I've entered this as a negative. So take off your initial investment to get your net present value. So don't forget to do that. If you forget to do that, you will lose marks. That's your net present value. Let's bold that. Just quickly zoom it down a bit so that you can see number 10. Okay, so that's my net present value. That's as hard as it gets for net present value. Internal rate of return is exactly the same, so I'm going to copy that, Just paste that there. Change that to IRR. And change this to IRR, open bracket, highlight all of it. Close brackets and hit enter. So it gives me an internal rate of return of 11%. Let's increase the decimal point just to see, 11.4%. So my net present value is positive. My internal rate of return is higher than my discount rate. So it's looking good for the Bunnings store so far. And now I'm going to do my payback period. So copy that, paste that there. Payback period. Now, actually, I can't do payback period there. Insert. And I'll call it cumulative cash flow. And what this is going to be is my cumulative cash flow. So I started with my negative 77. I'm going to add year ones and then fill it across. That will do it for me. Yeah, hang on. No, it didn't. Oh, sorry. I'm telling you porkies. Hang on. Delete all this. I did it in the wrong column. This one. So at the end of... So this is year 0. I'm thinking this is year 1. So at the end of year 0, at time 0, my cumulative cash flow is still 77. At the end of year 1, that's where it's got to be, is my negative 77 plus my negative 4. Now we can fill it across. I was going to say something didn't look right. That looks right to me. All right, so that's my cumulative cash flow. At the end of the year 2, it's my negative 81 plus my 5. This one is my negative 76 plus my 15 and so forth. Now, my payback period, let's open this a bit. Okay, so my payback period, go along until you find your last negative cumulative cash flow. So for me, that occurs here, which is at year 6. And just type in 6 years in that. Now, in this one, I want you to calculate days, months, and years. Well, you don't have to, but it's just showing your marker that you know how to. And all it is we're taking what cash flow we need out of what cash flow we're getting. Now, notice it's negative. We don't need the negative. So when we put our formula in, we will negate that sign. So equals... open brackets, just put negative here to negate that because we don't need it, divided by our total cash flow that we're getting, close brackets, and hit enter. Now what I want you to do is click into each of these and press F4, which makes it an absolute reference. That's pretty important because we want it to be the same. If we don't do an absolute reference, it will start doing, it will start taking the subsequent cells. Whereas if we do an absolute reference, this cell will always refer to these references, the absolute references that we have created. So for days, I want you to times it by 365. For months, I want you to times it by 12. And for years, leave it as a decimal. So when you're writing about it, so bold your payback period, when you're writing about it in your assignment, you can say payback period occurs in 6 years and approximately 15 days, or 6 years and half a month, or 0.48 of a month, or 6.04 years. So your marker knows. So let's just assume that our payback period, acceptable payback period is 5 years, then this wouldn't be acceptable because it would be outside our payback period. But we're looking at these two, especially the net present value dominant appraisal method. So at the moment, it's still looking positive for the Bunnings store. Now I'm going to do it all over again for the Coles store. So copy all of that just to make life easier. Paste it all here and change your figures. Change option 2. And it's the Coles store for option 2. Time period is the same. Okay, our cash flows are different because remember my cash flows for Coles starts with negative 135 for my initial investment at time 0. And at year 1, negative 5 all the way down to year 10 at 15 million. Then I've also got to take off in year 10, 15 minus the 1.5 demolition costs. So in year 10, I've got to remember to do that. So I'm just going to change my cash flow. Just quickly type that in. So it's my negative 135 and my -5 for the first year, -1, 10, 15, 15, 20, 20, and 20, 25. And in my last year, it is my 15, positive 15 minus the 1.5 demolition costs. Okay, I need to show some decimals. I was thinking that wasn't right, but it is right. Yeah, just check that my net present value is calculating correctly. All of this is right, but my discount rate is missing because I didn't make it an absolute reference. So just correct that back up to there. My rate, my cash flows are in the red, and I'm accounting for my initial investment. So that's good. So at the moment, it's telling me that I've actually got a negative net present value. So it's not looking good for the Coles store. I'm just going to copy this line, paste it in here, paste it in here, because that's my Coles cash flow. So I've updated my cash flow. So check that my IRR is calculating correctly, which it is. So I've got a negative internal rate of return. So again, keeping in line with my net present value. So not looking good for the Coles store. Now my cumulative cash flow, just make sure that it's calculating correctly. Yes, and it is. Increase my decimals on that last one to account for the half. Now, so we just need to delete that for now. Go along until we find the last negative, which is in year 10, and it's still a negative. So actually, this one is never paid back within the 10 years. So I need to write that. I'm going to write something like investment is never paid back within 10 years. And that's what I'm going to state. So again, keeping in line with the fact that it's got a negative net present value and the fact that it's got a negative internal rate of return as well. Not just below our discount rate of 10% or a required rate of return of 10%, but it is actually negative. That's a bit scary, isn't it? So this one's definitely a no-go. So if I was to appraise my options, I would be recommending that Wesfarmers proceed with the Bunnings store, but not the Coles store. So that's the option. That's how you complete it. Then you would come back to your Word document and you would explain your decision. It's very important to do the theory aspect. That's it. Hope you have fun. See you later.